So welcome to another important chapter for a theory question, derivative mishaps and lessons. Derivatives are like fire. You can use it for cooking. Fire can be used for cooking. Fire can be used for keeping your house warm. Okay. In winter, fire is very pleasant. But the same fire can burn your house also, can destroy the whole village also, can destroy the whole jungle also, forest also. There is a knife in your hand. Is knife good or bad? Depends on the user. Very good, depends on the user. Knife can be used for cutting vegetable, cutting fruit, several utility at home. That is why we keep knife. But there is another use of knife. What is that? Another use of knife, you can use it to kill somebody. You can use it to hurt somebody. Who is at a fault? Knife or the user? The user is at a fault. Derivatives are also like that. Derivatives were designed for hedging purpose. Originally derivatives were designed for hedging purpose. But what we have done? We have made it an instrument of mass speculation. The SEBI report says whenever you open some website, they will give you a disclaimer. 90% of the trades are speculations and 90% of the traders lose their money when they trade in derivatives. But derivatives are still very attractive. In India, the number of people trading in derivative market is more than cash market or stock market, because it is a quick way to become rich. You can make huge amount of profit, but at the same time there can be huge losses also. Okay, so this chapter gives you 3 stories where excess use of derivative product resulted into massive losses. So much losses that one of the companies, that is Bearing Bank, which is our second case study, it got wound up. It was a 250-year-old bank, and because of the misuse of derivative, it got wound up. It is one of the biggest scam, okay, across the world, derivative. So 3 cases our institute has mentioned there. These are quite popular cases. Derivatives were basically designed for hedging purpose, but what we have done, we have started using it for speculation also. In my first chapter, I had written this note: derivatives are financial weapons of mass destruction, and this quote is by one of the legendary investors, Warren Buffett, and he was proved to be correct. In the 2008 financial crisis in USA, about that we have spoken in the earlier lecture, so we will not repeat it again. There are examples, there are cases where derivatives have led to the end of that organization, have led to winding up of the organization, and those people who are managing them were brought down on their knees. Even big banks like Lehman Brothers had to be wound up. That story they have not given in the booklet. They should give that story also. Then there is a Bearing Bank whose case study is there in the book. It was wound up. Excessive use of derivative. If things go wrong, then you will incur huge amount of losses. You will fall like a pack of cards. Have you seen the house of cards? What if you remove one of the cards? The entire house will collapse. Same thing can happen in case of derivatives. you can suffer a massive loss. Then in the option chapter also I had told you two Nobel laureates, okay, Scholes and Merton. Black had died. Scholes and Merton had formed one company, long-term capital management. They also started using excessive derivative. Gone. Okay. So you can read their story in the book called The Rise and Fall of Long-Term Capital Management. If student is interested, the book name is Rise and Fall of Long-Term Capital Management. This book covers the entire story of how this company, Long-Term Capital Management, run by two Nobel laureates, finally became bankrupt because they had made the debt equity ratio 30:1. So much leverage. Derivative markets don't respect even if you are a Nobel Prize winner. Okay, that is the lesson. So we'll see one by one 3 famous cases. The first one is Orange County case. That is, in Orange County is a place, or you can say a municipality in USA, California. Have you heard California? Yes. So this is a story of Robert Citron. Who was Robert Citron? Robert Citron was the treasurer of Orange County. Like in India we have municipalities, Pune municipality, okay, Nagpur municipality. Similarly, in different countries that area is known by different name. Like in US they call it county. So Orange County, a California municipality, lost about $2 billion. $2 billion is equal to how many rupees? Anybody, any idea? $2 billion is equal to how many rupees? Let me check your general knowledge. That is roughly equal to, it is equal to today's rupees 17,000 crores. At today's rate of exchange, it will be somewhere close to 17,000 crore rupees loss. Okay, in 1994, which had a fund of about $7.5 billion. So municipality received money from all the members of that municipality from several funds. So they had a funds to manage of $7.5 billion, and out of that they lost $2 billion, and this is public money. Basically these municipalities are supposed to provide lot of infrastructure and other benefits to the people, and whatever property tax etc. they collect, they have to invest in a safe instrument, correct? But then greed overpowers human intelligence. Human intelligence is important, but then greed will overpower your intelligence, and then you start doing things which is not in the interest of the public in general, but then you do it. So what happened in this county? Treasurer was Robert Citron, despite the fact that having no background in trading of financial instrument. Amazing. He does not have any idea of trading in financial instrument. It is like a footballer goes to play cricket. He used derivative to speculate in interest rates using yield curve play strategy. Sir, what is yield curve play strategy? This fellow thought that I am the smart man. He will borrow at lower rate for short term. Short term rates were lower, and invest at higher rate for long term bonds. For long term, that is how normally interest rates behave in the economy. Normally, You have seen in the bond valuation chapter also, upward sloping yield curve. Short term interest rates are low, long term interest rates are high. So he borrowed for short term and invested in long term bonds because he was getting the interest differential. That is called arbitraging the difference between long term and short term rates. So maybe he was borrowing at, for example, 4% and investing in 6% or 8%. Just example, the numbers are hypothetical, not actual, so that you can understand. Making profit is so easy. So arbitraging the difference between long term and short term rate means borrowing at short term rates which were lower and investing in long term securities which have higher yield. But you are a student of bond valuation also. What happens when the market rate of interest rise? If the market rate of interest rise, if you want to understand the story, you have to participate. What will happen to the bond price? What will happen to the bond price? Rise or fall? Bond price will fall. Very good. Bond price will fall. Another question. Whose price will fall more? The short term or the long term? Long term bond will have longer duration. Do you know duration? Very good. Long term bonds have longer duration, so they will have more price fall. They will have more price fall. So this bond will suffer more loss if the price rises. But if the interest rate falls, if interest rate rises, a long term maturity bond will suffer more loss than the short term maturity bond. So this fellow was smart. He thought that interest rates are going to remain stable. What he thought? Interest rates are going to remain stable. So let me leverage. Leverage means borrow and invest in long term bonds. When your fortune is good, things are in your favor. Okay. Like a CS student, he has read only 10 topic, 5 topic he kept as an option. All questions come from those 10 topic. That is called good fortune. So he was having a good fortune between 92 and 93 because that time the interest rate was stable in USA and he was making huge profit. So he was telling his county that, see, we have created so much income because of this yield curve play strategy. But then his opponent told him, brother, you are taking too much of risk. But then if you are making profit, who bothers about the risk? He took one more bet. Not only to increase his bet in the structure of interest yield curve, Citron also used around how many billion? Not written. Some $1 billion of inverse floater. What is inverse floater? A structured note. If you want to write down, you can write down. He invested in inverse floater. Inverse floaters provide higher yield to investor who are willing to take more risk. Okay. So they will get much higher return if they are willing to take more risk. Inverse floater, if the interest rate goes down, you will get a higher return. If interest rate goes up, you will get a lower return. Inverse floater. So return will be inversely related to interest rate. If interest goes down, you get more return. If interest goes up, you get less return. So what this fellow Citron was thinking, interest rates will go down. And if interest rate goes down, I'll get more return. And he was confident that market has stabilized, interest rate is stable, our government is not going to increase the interest rate. So let me use this strategy also. And due to this type of strategy followed, this county fund had earned 300 to 400 basis point over the return earned by similar fund operated in the state. As I said, when you are running a good fortune, everything falls in place for you. You are earning 3 to 4% more than other funds. Okay. Other funds in California, Orange County Fund accepted funds from other municipality as well. Bring more money. Give me money. I'll give you higher return. Other municipality also thought that okay. So slowly and slowly the amount of fund managed increased to 7.5 billion. Now what they did, see, greed has no limitation. Then he started leveraging his position in repo market also. What is repo market? Repo market means you have suppose government security. Let us say Orange County has government security. It will use government security as a collateral and borrow money. That is repo market. And because you are giving government security as a collateral, you can borrow at a lower rate. You can borrow at a lower rate because you are giving government security to the other party. Other party is also happy that I have got security. I have got security. So let me lend money to this fellow at a lower rate. And using the borrowed money at a lower rate, again what you will do? You will invest in long-term bonds which have higher yield. You will use inverse floater which gives you more yield. This practice he followed many times, and now within a few years it has become 3 times more. From $7.5 billion fund, now it is $20 billion fund. Base is 7.5, but because of the borrowing, you borrow money and you again buy, so now it is $20 billion. It is like debt equity, you can understand. On a equity of $7.5 billion, you are able to create a fund of 20 billion. So remaining amount has come from where? From borrowing. That is called using leverage, use of debt. And you are a county, you are not a stock market broker or a stock market fellow. You are managing funds of municipality whose job is to provide health care, education, road, infrastructure, park to the people, and that money he is using for this kind of leverage position. Now many municipalities started understanding that something is going wrong. They started withdrawing the money from this fund. Okay. This strategy turned sour with a shift in the policy of Federal Reserve in 1994. What happened in 1994? Something unexpected happened which Robert Citron had not anticipated. Federal Reserve. What is Federal Reserve? It is like RBI. RBI in India, Federal Reserve, Central Bank. In USA is Federal Reserve. They started increasing interest rate. Hello dear, they started increasing interest rate. And how many times? 6 times. Oh my God, oh my God. Which this fellow had not anticipated. Now you are a student of finance. If the interest rates will increase, what will happen to long-term bonds? Long-term bond price will fall. Is it right? And what will happen to those value of government securities which you had used for borrowing money? These also are using as collateral, but their value will fall. Value of government security which was used for collateral purpose also have gone down. So when the value of this collateral will go down, you will get a margin call. You will get a margin call because the lender will say, boss, the value of your security has gone down. You please give me more money. You give me more money, otherwise return my loan. So now, because of the increase in interest rate between 94 to May 95, the county had to give 515 million in cash as margin to cover his position. Because in order to remain staying in the game, you have to keep on paying the margin money. When further interest rate rise, again you get a huge margin call. Otherwise the broker is saying, we will sell your bond at a loss, or you bring margin. Slowly and slowly the reserve of this Orange County started dipping. So if the reserve was 20 million or whatever, they started falling because you are using it for paying the margin money, you are incurring losses. And finally one day, you could not meet the margin. Even you are trading in derivative, be careful. You have to pay the mark to market margin. Do you remember that chapter, mark to market margin? If the loss happens, bring more margin money. The lender will not wait now, because lender has to recover his money. If you don't pay margin, they will sell the collateral. They started selling collateral amounting to $10 billion. $10 billion is something around 85,000 crore rupees in India. Big amount. Sending a shock wave in the bond market, and the price further collapse. When more people will sell, price will go down. Not only the other bodies who invested their money with county started looking at ways to exit. And those who had invested in county, Orange County, they also said, please return my money. What happens when some organization is failing and you have put your money in that organization? You will withdraw. Very good. So everybody, there was a run on this Orange County. They wanted to withdraw their money because they were not sure what will happen to their money. And because of this, finally Citron admitted that his county had lost $1.5 billion. So they had fund of 7.5. They lost 1.5. 20% of the fund value he lost because of excessive use of derivative, because of excessive greed. And finally he resigned on 3rd December 1994. This county was declared bankrupt on 6th December 1994 to prevent more investors from withdrawing their money. Okay, so for the time being, they will freeze the account so that nobody can withdraw money. And then this fellow was held guilty, sentenced to jail also, and he was fined $1 lakh as penalty. So that is about Orange County's case. First of all, you are not an expert in derivative trader. You are a county municipal commissioner kind of person whose job is to look after the funds, but they have to invest in safe securities, government bonds. Okay, but he started gambling on that, speculating on that, and using borrowed money. That is such a big crime. And I am surprised why there was no internal regulation to check this. Or maybe everybody was happy when the things are good. Yes or no? When the party is happening, everybody starts dancing. But when the party is over, then you have to see what is left. Okay. Another very popular case is Bearing Bank's case, where because of the one particular derivative trader, he is very popular, Nick Leeson, and because of this entire story which I am going to narrate, there is a movie also on him. Oh my God, rogue trader. So in case if you want to learn about this Bearing Banks case, there is a movie on this story of this, hero of this story, Nick Leeson. Okay, so he was a star trader of Bearings Bank. Star trader means they are basically generating more profit for the banks by using their strategies. So in investment banking business, those employees who bring more profit, they are called star traders. Okay, because they use their skill more efficiently and bring more profit. So he was a star trader of Bearings Bank, UK. He was carrying out low risk arbitrage. Earlier he was carrying out low risk arbitrage, no major risk, between the Singapore Stock Exchange and Osaka market. So he was basically an employee of a UK bank, Bearing Bank, but he was based in Singapore. He was staying in Singapore and he was doing arbitrage trading between Singapore Stock Exchange and Japanese Stock Exchange. This Osaka is Japanese Stock Exchange on Nikkei 20-25 future. In India we have index future, Nifty future. You remember Nifty future. In Japan it is called Nikkei 225 future, which is a Japanese stock index future similar to Nifty future in India, similar to Sensex future in India, right? So he will buy and sell in these two market, make some profit. Okay, so he was happy, his bank was happy. He will buy in the market where the price is low, sell in the market where the price is high, and make that arbitrage gain. Okay, up to this is simple. But then what happens, in some of the trade, Nick Leeson incurred huge losses. What happened, he has to punch buy in the system. Instead of punching buy, the employee had punched sell. Possible. On the computer screen they will ask you buy or sell. So if you tick suppose sell, the transaction is recorded as sell, but you were actually wanting to tick buy, right? So there is a drop down box which will say buy, sell. So your arrow, instead of hitting this buy, it hit this sell, and it happens in this business, nothing unusual. So that is why they have lot of controls, but still some human intervention is there. What the computer will do if you punch sell instead of buying? Buying means you are expecting price will rise, but against that you punch sell, so you will suffer loss. Because of this there was a loss. Understood? Because of a wrong data input. So that employee of this bank who was working under Nick Leeson, he will not do punching work. He has got employees. Like in your office, your boss will not do account writing. You do account writing and you may punch 5,000 instead of 500 rupees. So boss may suffer the loss. Am I right? So bank said bank had a policy that if you make mistake, you will be discharged, you will be fired. But Nick Leeson was a gentleman. He thought that let me not fire this employee. He said, don't worry, we'll do something. He created a suspense account. And transferred that loss to suspense account so that it will not be reported. That was his idea. There was some, let's say something around $2 lakh loss, 2 lakh or $20 lakh loss. He said that I will do another trade and I'll make the profit and I will square it off. so that bosses will not know. Is it right? Understood? So basically the whole game started because of a loss incurred in one of the trades which was by mistake, as they say it. I don't know, that they wanted to punch buy, it got punched as sell or something, and then in future market it can be a severe loss. He started taking speculative long position on Nikkei future. Earlier he was an arbitrager. In arbitrage you don't have major risk, but now in order to recover this loss, he started taking speculative position on this Nikkei future on both the exchange in the anticipation of price rise of the same. So he wanted to recover that loss so that bosses will not know. Then he took speculative position. Such action of the listen exposed the bank to two major risks. So now the bank has got market risk, the bank has got event risk. Market risk means the market price can fluctuate and you can suffer the loss. Event risk means some event can happen. Some event can happen which can result into huge fluctuation. Like Corona was an event in India. Earthquake is an event. Okay, tsunami can be an event. Change in political party are events which can cause unexpected fluctuation in the price. So he was exposed to two risks, market risk, event risk. Now one more problem, this fellow, he was not only the trader but he was also in charge of the back office, that is settlement operation. So there was no proper division of work. A person who is a trader working on the floor where the trade takes place, he should not be allowed to enter the settlement operation room. Am I right? In your auditing you learn division of work, internal control. One person should not be allowed to do everything. If one person is allowed to do everything, then he can manipulate. But in this case, he was also looking after their back office, settlement operation. So he went to the staff, he told the staff, why we need to remove this employee? Why don't we just make some accounting adjustment? And because he was a boss, like your boss will say, okay, you do this accounting, will you refuse? Otherwise he will not give you articleship completion letter. You will say, why I am bothered? My boss is saying I'll do it. So he created an error account. He used an old error account. This company has an error account which is, let's say, a suspense account in your accounting language. So these banks maintain error account where if some amount is by mistake received or paid, they will put it in that error account till you find out this error belongs to what. So error account is like your suspense account, and he transferred that loss to that error account which was given a number 8888, and but he was able to show a profit of substantial profit in 1994. So loss he has hidden, that big loss that he incurred was hidden, and for the other transactions he made a profit of, he made a huge profit. And see the fun, he got bonus also in that year. He got bonus. Oh my God, that is another tragedy. The fellow made a mistake and you gave him the bonus. How much bonus? $750,000. Huge amount. To some extent it can be termed as an oversight by the management in 1994. Oversight means management did not apply proper due diligence. Then what happened? You have taken a long position. You will be asked to pay margin call. Listen asked his bosses, I need 354 million margin call. $354 million margin call, and his bosses said, okay, go ahead, no problem. They did not ask him the question. if you don't ask him the question, what will happen? He will do it again. Boss is thinking he is using arbitrage. Listen is using speculation, which are exactly opposite. Okay. Then in January 1995, guessing that now Listen is thinking Singapore and stock exchange would remain stable, they will neither go up or down. He built a future position on both exchange with a total notional value of $7 billion. Is buying. And how much is his open position now? $7 billion in Singapore market and Tokyo both. And then he also started selling future on long-term and short-term Japanese government bond also. He's buying on index future, he's selling future on short-term, long-term Japanese government bond. The main reason for the strategy was that interest rate moves in opposite price in the opposite direction of the price of the debt. So if interest rates will go down, bond price will go up. If interest rate goes up, bond price will go down. And he was very sure about it. This position would be profit if there is a rise in the interest rate in the bond. If the interest rate will rise, bond price will fall, and he has taken a short position. Human beings cannot predict what can happen tomorrow. Keep my words in mind. No amount of human intelligence can exactly predict what can happen in next few days. Am I right? Everything was going well according to the plan. Suddenly, on 17 January 1995, there was a big earthquake in Japan. Can you anticipate earthquake? And when the earthquake-like event happens, it was a massive earthquake. Both Japanese stock market and interest rate plunged. So see the bad luck. He has taken a long position in the stock market, that has gone down. He has taken a short position in the bond market. He was expecting interest rate will rise. Actually, interest rate has gone down. So huge loss in the stock market, huge loss in the bond market, totaling to 827 million pound. In your book, if dollar is written, make it pound. In your book, if dollar is written, make it pound, because it was a UK bank. So the calculation was first done in pound, and its equivalent amount in dollar is $1.4 billion. So lost on index future, he lost on that bond short position in bond also. Total loss is 1.4 billion US dollar, or you can say 827 million pound. So on 23rd February, finally this fellow Nick Leeson left Singapore, and on next day the management of the bearing banks were informed about the situation. Now the management woke up after this event to meet the requirement of the funds, because you have to pay margin. You are a reputed bank, you can't default. Then the bank had to pay that huge margin, so much margin that this bank had become bankrupt in March 1995. A 233-year-old bank. It was a 233-year-old bank, and because of the excessive greed, massive use of derivative, it has become bankrupt. And do you know at what amount it was taken over by Deutsche Bank? Deutsche Bank purchased it for £1 only. The whole bank was acquired for £1 only, means 100 rupees only. You can also buy. If you had 100 rupees, you could have also bought this bank. Is it right? So that is the big tragedy or big story about this bearing bank. You can do research on it if you are interested. You can watch the movie. Which movie? Rogue Trader. Okay. And in US, UK, there are such traders who take excessive position. They are very greedy because their bonus depends on that. Can you see how much bonus he earned? $7,50,000. If you multiply by suppose 85 rupees per dollar, it comes to 6 crore, 37 lakh 50,000 rupees, 6 crore rupees bonus. That is the total amount you will earn in your entire career. Is it right? Probably more than that also, but in general an Indian will earn this much amount in his lifetime, a normal Indian employee, and he got it as a bonus in 1 year. Another story is of Procter and Gamble and Gibson Gritting case. This Procter and Gamble, you know, Gibson Gritting is a gritting card company. Okay, you can send Valentine Day gift using this gritting company. There was a bank called Bankers Trust, BT. We'll call it BT, a banking organization, and this created complex derivative product. So complex that usually you don't know what will be the outcome of this product. You can't anticipate what can happen if something goes wrong, like it happened with Listen. Okay, so they created a product and they started selling them to their clients, including two big clients, Procter and Gamble and Gibson Gritting. Because of this complex product, these two companies suffered huge losses. And it was a wrong selling also, mis-selling. What is mis-selling in this financial market? Mis-selling means you give wrong information to your client. You are telling your client that this derivative will meet your individual need, but actually did not. Okay. Second thing, you are selling products to your client without understanding their risk appetite. Am I right? Tomorrow you will become, suppose, a financial planner. You, after qualifying, you can become financial planner, where you can give financial planning advice to your client. What you should do? Understand their risk appetite and identify those products which will be useful for your client. Your 60-year-old client come and you say, no, you buy call option, you buy put option, you buy commodity derivative. Is it a right advice? This fellow has retired. His money has to be kept in safe place, so that principal is safe and he keeps on earning some interest. He can enjoy his life in a routine manner. And you tell him that no, buy call option, it's huge profit. Okay, and one day he loses everything. Same thing happened here. This BT, they gave wrong advice. They did not understand the risk appetite of their client. And finally, one day what happened? These two companies, Procter and Gamble and Gibson Gritting, they took BT to the court. And finally a settlement was made out of the court, huge amount of money. In this 1999, this banking organization was taken over by Deutsche Bank. Same, BT was taken over by Deutsche Bank. So what is the thumb rule? Derivatives are not bad, but derivative products, if complicated, if you don't understand, then please do not participate in that. Similarly, as an advisor, if my client does not understand a particular product, then don't offer this to him. Is it right? So that is the moral of the story. Now briefly, the story is printed in the book. In this case, What was the strategy? BT sold leverage swap product to P&G. Now this itself is a very complicated name, leveraged swap product. What is a leverage swap product? It is also called ratio swap or power swap. It's just like any plain vanilla swap, with the difference that receipt or payments are adjusted by a multiplying factor or a leverage factor. So they are saying like this: if interest rate goes down, we will pay you floating rate to the power 2 divided by 6. So your payoff will be like this. Now have you understood what they have written? Floating rate square divided by 6. You can't visualize the impact of this. If it increases by 1, then 1 by 6 you will get 1 square by 6. But if it increases by 2, you will get 2 square by 6. If it increases by 3, 3 square by 6. Now you see the impact. 4 square by 6. 5 square by 6. So the effect is in multiplier. And as you know, derivative works both ways. It can generate profit also. It can generate losses also. If the profit can be multiplier, you will be happy. 5 square. Losses also will be calculated like that. So therefore one cannot visualize what would be the impact of such derivative, and therefore kindly keep yourself away from this. As an advisor, as a professional advisor, don't advise this to your client also if it does not meet his requirement, if it does not meet his risk appetite. So the effect is multiplying effect, magnifying effect, because of the compounding with interest rate movement. Can you see multiplying effect? 1 by 6 means say 0.17 or something, but the moment it is 2 by 6, it becomes 0.33. And the moment it is 3 square by 6, it becomes 9 by 6, 1.5. 16 square by 6, 2 point something. Then 25 square by 6, which is 4 point something. You see the speed at which the payoff will change. The speed at which the payoff will change, and derivative always works both ways. The structure of the deal was such that P&G could make a profit if there was no change in the rate of return on the two bonds, or if the rate of return did not increase to the point where the spread was a positive value. So the deal was structured in such a manner: if there is no movement in the interest rate, you don't lose. If there is a small movement in the interest rate, you make some profit. But this did not tell them that if the interest rate changes by a high percentage, what can happen. So initially the profit was reasonable, 0.75%, and he was happy. But then what happened? Later on the interest rate started increasing. Similar product was sold to Gibson Gritting also. So under this agreement, Gibson will receive 5.5% from BT, agreed to pay floating rate squared divided by 6. If the interest rate is falling, you will get the difference. But what if the interest rate rises? If the interest rate rises, you will incur loss, and the loss will start increasing exponentially in multiplier. And because of this complex derivative product, this company Gibson Gritting suffered a loss of $3 million as interest rate increased, because Federal Reserve has tightened their monetary policy. In April 94, further loss 16.7 million. P&G suffered 106 million. So they go to the court. They say that this product was not properly explained to us. And finally there was an out of the court settlement, and this bank, BT Bank, was taken over by Deutsche Bank. These are the three famous stories. There are many more. In recent time, there was a story of Silicon Valley Bank also. Okay, where also this bank got bankrupt. Then Lehman Brothers case I have told you. Lehman Brothers case. It is a big investment banking. It was a big investment banking, right? So the question is, what is the moral of the story? What have you learned from these three stories? Tell me, did you learn anything from these stories? I am asking all of you. Anybody wants to reply? What did you learn from these three stories? Do not invest in something you don't understand. Very good. Do not invest in something, do not buy such derivative product which you don't understand and you don't know what the end result could be. Like this last example, Procter and Gamble, they entered into some kind of derivative product which will give them payoff equal to floating rate square divided by 6. So initially they did not visualize what can be the effect of that. Any other lesson you have learned? Any other lesson you have learned? Come on. Any other lesson? First of all, you should have a strong internal control system. Because in the earlier example, Leeson was taking position after position and there was nobody to check that. There must be proper risk management technique in the organization. They should use speculation, but then they should define the limit a person can speculate. Do not give free hand to a trader and take any position. Then should be monitoring system on a routine basis. Okay, monitoring system should be there. You should monitor daily what are my outstanding position. Okay, so that is why many companies nowadays have lot of controls in place. There are limits fixed. Just like your credit card company puts a limit on your credit card. Do you know that? Like for example, your credit card would be 1 lakh rupees limit. At the most, what you can do? You can spend 1 lakh and you may not pay to that bank, but they will know you will lose 1 lakh. They will lose 1 lakh only. If suppose you are given a credit card with no limit, the person will buy entire Taj Mahal and Buckingham Palace with that credit card and run away. Okay. One student has said that before making investment, study the product. Very good. That is, if you want to invest in any particular product, understand its feature. What are the potential gain, but at the same time, what are the potential losses and to what extent the losses can go up to. Like we say in call option, the profit potential of a call buyer is unlimited, loss potential is premium paid. But if you want to become a writer, you should know profit potential is limited to the extent premium received, but the loss potential is unlimited. Very good answer. One has to understand the product. That is why we say if you don't understand the stock market, don't invest. Okay, if you don't understand derivative market, don't put your money because you don't know what can be the implications. And some of the companies can to extent be wound up. One student is saying too much is too bad. Very good. Too much is too bad. Greed. Okay. Too much greed is bad. Small greed is good. Too much greed can lead to disaster. Too much of anything is bad. Excess of anything can be bad. So I will go according to your syllabus now. There are some lessons we can learn from these three stories. First is, do not buy any product that you don't understand, especially the complex derivative products which you don't understand fully. Nowadays on YouTube you will find lot of people are explaining you call option, put option, interest rate option, forex option. Just don't go by what they are saying. Do a detailed analysis, make your own study. Then if you understand the product, then you enter into that, and maybe usually you can start with the lowest quantity, maybe one lot only. If you want to trade in future option, you can start with one lot. One lot may not result into a massive loss also. Is it right? Again, there also you can start with something which is less risky, which does not fluctuate much more. So maybe you can start with a top companies like say Reliance or Infosys or TCS. How much will be fluctuation? 2-3%. They are not going to go down by 25%. Is it right? So therefore that is how you can start if you want. So that is my first lesson. And you can see this Procter and Gamble and Gibson, they did not understand the product, and then they started telling trading in that. Then same thing with this Robert Citron of Orange County. He was not a trained trader in derivative, and therefore that is why without proper financial background, without proper studying the product, he started trading. Second thing which every company should do is to have due diligence, before making treasury department a profit center. The purpose of treasury department in a company is to reduce the risk, raising of funds, investment of funds in safe instrument, and managing the risk. That is what is the usual function of a treasury department. But what this first company, Orange County, they have done, the person who was looking treasury department, he started using financial products to make profit. Treasury department is not supposed to indulge into too much profit making. Of course, if the board permits or the authorities permit, the senior authorities permit you to do that, you can do it, nothing wrong. But at the same time, before you allow the treasury to start making profit from financial product, do proper due diligence. Okay, due diligence means ensuring that everything is properly controlled. It is as per the policy of the organization. There is not too much of risk. You will assess the risk involved. That is due diligence. Like when your father will choose a bride or a bridegroom for you, what will they do? Yes, Divya, if your parents choose a bridegroom for you, what will they do? Due diligence or no due diligence? Due diligence. What they will ask? Background they will check. They will check the salary statement also. Yes or no? They will say whether the property is owned by you or you live in a rented place, whether you smoke or drink and eat that gutka thing, pan parag thing or not. What is your educational qualification? Then what is your nature? Don't you think if you are putting $1 billion in some product, you should do due diligence? Same logic applies to financial market also. The logic which a parent applies to select a proper bridegroom or a bride, same logic you should apply when you are putting your money in the financial market. Okay, how much risk one can take should be defined. What is the limit they should define? Which product they will use should be defined. Okay, that is due diligence. What is the risk, maximum risk you can take is to be defined, and therefore you can go ahead with the derivative. Nothing wrong in derivative. Derivative is like a knife. Nothing wrong with having a knife in your hand. It is useful for so much of household work. Can you imagine your household a day without a knife? No. Okay. So therefore, the best way to avoid this situation is to avoid linking treasurer's salary with the profit he made for the organization. Because if you link the profit salary with the profit, like in case of that listen, it happened, he got $750,000 bonus. So what he will do next? Next day he will enter into more transaction. Next point, specify the risk limit also. That is very simple. How much risk a trader can take should be specified, and he should not be allowed to take more risk than that. Then there is one more note which says that before a trader becomes speculator from arbitrager, then you have to ensure that proper risk is defined for him. Leeson was an arbitrager, but he became a speculator, and the company did not put an upper limit on his ability to take that risk case, how much position he can take, and because of that, this Bearing Bank, 200-year-old bank, had to go into bankruptcy. Okay, so put the limit. Simple example is your credit card company puts a limit on you. You cannot spend more than that. The moment you try to exceed, your card will not work. Then in your net banking account also, you can put the limit on daily expenses. Am I right? You can put the limit on international spend also. You can put a limit on daily card expense. So even if you lose your card, the person who will get your card, he can withdraw the limit only. Am I right? So these are what? These are risk management. Same thing can happen in big financial organization where they give limit to the trader, and they have to monitor that this limit is properly observed, reported, etc. And division of labor. Division of labor, there are people who take call on the trade. There are back office employees who do accounting work, who do settlement work. In fact, I have seen in big companies, the person who works in the front office, he cannot enter the back office. That access card does not allow him to enter the back office. That is so much control they take care. And after all these derivative disasters which have happened, companies have become more careful now. So when you will join some big organizations, like you join JP Morgan, Morgan Stanley, okay, which are big names in investment banking, Goldman Sachs. So if you are a trader, you will be access only to the trading area, trading desk. If you are a middle office employee, you will be allowed to access only that. You can't enter the trading area. And if you are an account department employee, you are not also allowed to enter into front office. Access is not allowed. The moment you access, the HR department will get the alert, and they will call you, warn you. If you don't listen to one more time, they can fire you, because the integrity of the organization has to be maintained. So therefore, the strategy is that such organizations which are doing trading in derivative products and financial products, they should have 3 offices. Okay, front office, middle office, back office, but they should be separate. There should be a firewall. What is firewall? Just like in computers we have, outsiders can't enter into your computer. Okay, similarly here you have access area. They are not allowed to access those areas. In the functioning of the office, one person should not have access to functioning in the other office. You remember that Leeson case? He went to the accounts department and he transferred the loss to one suspense account, error account 8888, which is mentioned in your notes also. So if you have internal controls in place, then the risk can be reduced to a large extent. Some of the companies, they keep offices in different location only, not in the same building, so that again there is no mixture. So access card is given through which you can't enter the other area. Then next point is, ensure that a hedger should not become a speculator. The person whose task is hedging or arbitrage, he should not be allowed to become a speculator, because once he becomes speculator, he will take a higher risk. Okay, and these are the ways you can monitor your risk. Last is, carry out stress test and scenario analysis. This is where Procter and Gamble and Gibson Gritting failed. What is the meaning of carry out stress test? You have to see if interest rate changes by this percentage. The formula is, for example, floating rate square divided by 6, for example, or any such product. Like in call option, put option also we have seen. In call option we draw this diagram. This helps us to know how much my loss and profit will change according to price. For a writer, we draw this diagram. The writer should know that if this is the price, this is the price, this is the price, this is what the loss can be. So you should see, you should create multiple scenarios. Okay, in case of underlying is a share, if this is the share price, this is the share price, this is the share price, what will be my profit or loss? If it is something relating to bonds or a debt instrument, if interest rate is 1, 2, 3, 4, 5, 6, what would be my profit or loss? That is called stress test and scenario analysis. If this happens, how much I can lose? Okay, that is called stress test and scenario analysis. So in case the underlying is linked to an interest rate product, how much the value can change because of 1% change in interest rate. In case the underlying is related to share market, how much loss can happen if the share price changes. If it is related to forex market, if the underlying is related to foreign exchange rate, how much the losses can be there if the exchange rate changes by 1 rupee, 2 rupees, 3 rupees and like that. So there is a technique called value at risk. VAR means value at risk. So this technique is used, under which you will get to know how much losses you can suffer in a given scenario. Value at risk is a different chapter in the syllabus. So that will help us to calculate how much losses that we can have in a given scenario. Try to visualize 2-3 scenarios and see how much losses you can have. Can we absorb that loss? Can we absorb that loss? Okay, so this is about this amazing and wonderful chapter. One last paragraph also I'll explain. It will be better to refer to data of at least 10 to 20 years to anticipate a black swan event. What is a black swan event? Students, write down. Black swan event means something extremely rare, unexpected and unpredictable event. Extremely rare, unexpected and unpredictable event that has significant and offers severe consequences. Please write down the last line. Means don't think that it can't happen. Earthquake. You could not visualize earthquake can happen. But you see the history of last 15 to 20 years. In Japan, earthquake is more common. Corona may not have happened in last 20 years. But now in future, whenever we do stress testing or scenario analysis, we will keep in mind, what if a corona like situation comes again? how much money I can lose. Is it right? What if an earthquake like situation comes again, which is extremely rare, unexpected? But if that event happens, how much can I lose? Even that should be kept in mind while using derivative products. Okay, so the conclusion is derivatives in themselves are not bad. The use of derivative can be good or bad. Okay, any query on this? No query. Anybody, any query on this? No query, so we conclude this chapter.